at Kotak AMC in our special segment, Fund-tastic Managers. Harsha, thanks so much for dropping by to our studios.
Thank you so much. Happy Diwali to you and all your viewers.
Thanks so much for that. But it doesn't look like it's going to be a very happy Diwali. If you look at the market setup right now, yes, we have recovered a bit, but it is expected to stay a bit more sideways because the earnings have been on the weaker side. Would you concur with that view?
Anisha, clearly earnings have been on the weaker side, not just in the September quarter, but even the quarter that has gone by. We have seen weaker set of numbers, and most of it was expected, I would say. It's not unexpected in that sense. However, given the fact that valuations have been on the higher side and earnings have not been meeting up to the levels that valuations warranted to be, there could be a time correction in this market, and we have already seen some bit of value correction already. So yes, I think we all know that equities cannot be one-way street. So to that extent, yes, one has to be ready for some volatility and also be there in the market for the long term.
But then how long do you expect this time correction to last? We have already seen a 2,000 points drop in the market. Is there more downside that you expect, given that earnings are actually not picked up in the second quarter and not expected to pick up at least in the second half as well?
We have had very good 4 years of equity market. So to that extent, what we have seen is not even 4 weeks of correction, right? So to that extent, it's very difficult to predict how long this correction would continue. But clearly, I think if you look at the valuations on the large cap side, the valuations are okay after the correction that we have seen. But in the mid and small cap segment, the valuations continue to be on the elevated side. So to that extent, I would say on the large cap side, probably we have seen most of the correction. One can't really predict exactly where it will bottom out, but most of the correction in the very short term seems to be behind us. However, on the mid and small caps, it all depends on how earnings would pick up going forward.
But within large caps, where would you say that the maximum amount of comfort is? Is it financials? Because that seems to be the consensus trade, but that was the consensus trade even at the start of the year. But it hasn't really picked up in terms of share prices. What do you think is the impediment for the banking sector not to do well right now?
See, if you look at purely valuations, I think compared to where we were 5 years back, markets definitely have been on the higher side. Compared to 2019 valuations and today's valuation, you will clearly see most sectors have got elevated valuations today. In that context, there is only one segment which is probably at the same valuation or lower than 2019 valuation, which is financials.
True.
And even within financials, I would say banking sector is the one which has not performed at all. So to that extent, purely from a valuation perspective, you have got a lot of comfort in that segment. However, as you rightly said, there are certain headwinds in the short term. So to that extent, we may not see a great pickup in terms of the performance of the financials immediately. However, if you are a patient investor, if you are making your staggered investments into banking segment for the next 6-9 months, I'm sure the long-term investors will still make money.
But within financials as well, because it's become a very large sector, right, from PSUs to private to insurance to AMCs and whatnot, and even
NBFCs.
MFIs and NBFCs, what's the pecking order within all of this?
Clearly, large cap banks, both private and PSUs, from a valuation perspective, seem to be better placed at this point of time. From a medium to long-term perspective, while the valuations are on the higher side, we believe all the capital market-oriented financials, whether it is asset management companies, wealth distributors, the brokers, etc., although it's going to be more cyclical part of the business, we believe that that's likely to continue doing well. So both these pockets, depending on how much you want to look at very short term and position for the longer term, etc., you can look at these two segments.
Okay. Coming back to your earnings point. Now, for the second quarter, obviously the PAT growth is the lowest in the last 17 quarters that we'll be seeing. For H2, are you expecting some recovery? And if you're expecting some recovery, which are those sectors which will be leading this recovery?
Yes, there will be slightly better set of numbers in the second half. That's the expectation at this point of time. A lot would depend on how the festive season goes in terms of the demand. Although we are seeing mixed signals from the festive season, it's not been so strong across the board. So to that extent, even H2 numbers are a bit of a question mark at this point of time. However, compared to where we are today in terms of first quarter earnings and the ongoing second quarterly numbers, we believe that H2 should be better, and that should also give a little more comfort to our markets. And another main issue has been our inflation has been under control, and now we have seen crude also correcting quite a bit. And with a lag, we should be able to see some improvement in margins across the board, and that should help profitability in the second half as well.
Okay. And which are those sectors that will be leading the earnings growth?
We believe that IT services and pharma should give a stable set of numbers, and industrial should pick up in terms of earnings, given that the government spend has not been strong in the first half and is expected to pick up in the second half. We should see that helping some of the industrials, both in terms of execution and also in terms of the sentiments, because the order book is also likely to benefit from those orders.
Fair enough. Perhaps in the second half of the year, the government as well as the private capex and state capex is expected to pick up. But I wanted to ask you about the FII outflows, because that's the moot point of this pressure that we are seeing in the markets. 1 lakh crore in a matter of less than a month. What do you think will be the trigger that will reverse the FII outflows?
Anisha, first of all, we have been speaking a lot about FII flows and how it impacts the markets. But I would like to say that over a period of time, the dominance of foreign flows in terms of determining our market movement has reduced quite considerably. I'll share few statistics. If you look at the pandemic period, at the beginning of the pandemic, for about a 3-month period, they sold close to about 65,000 crores. And the markets fell almost 30-odd%, right? But between October 2021 and June 22, for a prolonged period of about 9 months or 3 quarters, they sold 4 times more, which is about 2.5 lakh crores, right? Ideally, market should have fallen more, but actually markets fell only about 16%. That too, I'm talking about Nifty numbers. And now, the third episode, a 1 lakh crore selling in a very, very short period of time and very concentrated selling has not made much of an impact on the market. Yes, markets have fallen 7-8%, but compared to how they used to impact the markets, we have not seen that kind of an impact. And the reason being now, not only flows, but also the stock that is held by domestic institutional investors and foreign institutional investors seem to be very balanced. And also there is a new segment of market that has started to give cushion on both sides, whether it is lower side or on the upper side, which is your dynamic asset allocation products, right? So even without any change in terms of flows into the particular category of funds, if the valuations go up or go down, some of these funds can move from fixed income to equity or vice versa. So that's also helping the market volatility a lot better in this sense. So I would say FIIs will be important, but I don't think will be as important as what they used to be in the past.
Let's take a step back, and there's a few questions that I would want to take with you. But before that, you're saying FIIs, of course, is something you shouldn't worry about because DII flows have been strong. Are DIIs showing any sign of fatigue, or has the SIP come off or anything like that? I know data for now doesn't support it, but what's been your anecdotal kind of sense speaking with investors?
See, all of us have already seen September data. Nothing has changed in the September data. And as we have seen at our end until end of almost October now, we have not seen any significant change in terms of the flows despite market showing downside volatility. So most likely the SIP numbers should continue as they have been in the past. But yes, the lump sum inflows or outflows could be dependent on various factors, so difficult to predict. But overall, I think we are still in for good, healthy flows from domestic investors.
Okay, healthy flows coming in, but where are those healthy flows going? That's the first question that I wanted to ask you. If you had to make a pick as to, whether the money should go in a multi-cap fund, a large cap fund, a thematic or a mid-cap, which one would you bet on right now?
Given the valuations currently, I would be looking at large cap tilted funds, which means that it could be large cap, completely large cap funds, or a flexi cap fund, or large and mid cap category, or even multi cap, which also has a reasonable amount of large caps. I would avoid taking lump sum investments into mid cap or a pure small cap strategy at this point of time.
Okay, so large cap is the bet coming in as far as the mutual fund is concerned from the Fund-tastic manager today. But the next question is what kind of nifty returns we should expect in the coming Samvat? And I ask you that because we have seen 2 great years of returns. I think above average 19-20%?
That's true.
Calls for a bit of a moderation, doesn't it?
Clearly, I think next Samvat is going to be a year where markets could consolidate at least in the first half. So to that extent, one should clearly moderate their expectations. And we have seen fantastic last 4 years. I don't think that can be repeated. If it happens, it's a bonus. But otherwise, we should be okay for a more moderate set of numbers in this Samvat.
Yeah, recency bias calls for a better and even a better kind of return, but no, it cannot be repeated at least. The next one that I wanted to ask will come up for you on the screen, and that one, of course, is the question, which is going to be the best asset class for somewhat 2081? I know you'll have your bias towards Indian equities, but take a look at gold. What, 33% up this year already? Debt, of course, at that cusp of the interest rate cycle churning, and global equities, whether it's China or US, both look quite healthy. If you had to take a pick, what would you bet on?
I would still tilt towards Indian equities, but yes, I think gold is likely to continue its positive run. So to that extent, maybe some bit of investments into gold and silver and some into Indian equities. That could be our suggestion.
Okay, so these are two that you need to bet on when it comes to the portfolio allocation. But what's the biggest risk for the markets that you see in India? Because of course valuations are punchy. Globally, we have seen, wars going on and it's not subsiding, plus elections, etc., which are lined up. Earnings we discussed in detail that haven't been impressive. And of course, a bit of a macroeconomic tilt here in the sense that inflation hasn't really moderated to the extent we wanted. What do you think is something that you're watching out for the most closely right now?
More than global factors and macroeconomic factors, I would say earnings and valuations at this point of time would be very critical for the markets to continue giving healthy returns. As we have seen earnings moderating over the last couple of quarters, I think all eyes will be on H2. And especially given that it's also a heavier half compared to first half, we should be able to see slightly better numbers there. And if that were to happen, I think the confidence can come back into the markets.
Okay, let's see confidence comes back or not, and confidence comes back into which of these sectors then? You did talk about IT sector leading growth, you talked about financials seeing a decent valuation comfort, and energy transition is of course a big theme. If you had to pick one sector for somewhat 2081, which would that be?
I would probably pick IT services at this point of time.
Okay, IT services has done well in the last 2-3 months, but it's expected to continue. Samad, do you want to take over and ask Harsha about some of his other recommendations as well?
Well, there's one sector that I would want to talk to you about, and that's the PSU. If you look at the last Samvad, the first half PSU stocks, in fact, defense stocks, were the talk of the town. But of late, we have seen a steep correction when it comes. Some of them have dropped nearly 50% from the peaks. So after this drop, does the defense space or does the PSU space look interesting?
First of all, I don't think we should look at it only based on ownership, because we don't look at all private companies as one basket and all PSUs as one basket. Yes, at a point of time when the valuations were very, very low, probably everyone believed that PSUs would outperform, and that has already played out. Now, given the fact that the businesses, underlying businesses are different, the valuations could be different in some of those segments as well. I think we will have to look at more from a bottom-up perspective. There will be a set of public sector companies which will still show reasonable earnings growth, and also valuations are on their side. So some of them will still continue to outperform. But as a basket, I think we have already seen one level of outperformance from very low valuations to the valuations that we are in currently. So to that extent, we may not see a uniform rally across PSU segment. And depending on the businesses and the valuations, I think we'll have to look at them.
And lastly, sir, before we let you go, we need to roll this wheel of fortune here.
Sure.
So will this roll this? Whichever question comes, you have to answer.
Sure.
Well,
that's a question
so
everyone wants to know.
If you can't give a stock, at least a sector.
I would say that rather than looking for a multi-bagger, I think now it's a time to look for long-term investments, long-term compounding investments. I'm sure that most mutual funds are doing a good job in terms of creating that long-term wealth for investors, and investors should continue to bet on mutual funds and look for long-term wealth creation with asset allocation in mind rather than looking for multi-baggers. I think the easy multi-bagger era is behind us. I think it's going to be more challenging as we are at elevated valuations and also earnings are slowing down. So I would say moderate your expectations and look for long-term returns rather than multi-bagger ideas.
So no multi-bagger idea, at least for the next summer. Let's see how it goes. For the next question here. And okay, your biggest regret?
No, absolutely no regrets. I think
Wow.
if you miss some investments which have given fantastic returns in the past, our job is to find for new avenues, and hopefully we'll be able to find some of them this summer as well.
And the last one here.
Well, I have the question, forget about that. Learning from last year is what I want to ask him. Which is your biggest learning from this year?
I think clearly valuations have moved up quite a bit. So to that extent, expecting uniform rally across sectors may be a thing of the past. It has to be more stock specific, and we have to focus more on earnings. Last year, probably the earnings disappointments were much lesser, and so to that extent, it was a uniform kind of a marketplace. This year, I think there will be a differentiation in terms of how stocks do. Based on earnings and valuations. I think that will be something that we need to keep in mind, not just go by what has happened in the past.
Yes, don't go by recency bias. This year might be different. With that, we'll wrap up this conversation. Thanks, Harsha, for